Hi, this is Tim Maurer and Drew Tignanelli from the Financial Consulate. There are a lot of things going on in the world right now. We thought that it would be a good idea to have a conversation about that. Drew, Europe persists as a problem. We thought we had a deal last week. The markets are rallying like crazy, and then this week we hear about a referendum and things are still in question, and all of a sudden the markets are in a tizzy again on the downward side. What's going on in Europe, and what can we expect out of that situation?
Well, you have to keep in mind, Tim, that we've had at least 4 deals now. So
yeah.
We had a deal in 2009, a deal in 2010, early 2010, late 2010, and now just a deal a few weeks ago. And every one of those deals has been a lot of talk and not a lot of substance.
Right. Not a whole lot of implementation.
Not a whole lot of implementation, not a lot of substance. If you take the deal that they announced last week, it really comes with a lot of sketchy, we're going to do this and we're going to do that. Yeah, we're going to have $1 trillion, but we're going to get that somehow over the next few weeks and so forth. And yes, this is going to happen and that's going to happen. And also Greece, they said they're going to forgive Greece 50% of their debt, right? Sure. So the debt to GDP of Greece was 160% before the deal. Okay. After the deal, it's going to be 120%.
160, 120.
Right. Now, I'm only an accountant. I'm not a mathematician or a politician. So, you know, 160, 80 is about 50%, last I heard. But the reason that it's only 120 is because it's not 50% of Greece's debt. It's 50% owned by the banks.
Okay.
And that's banks in the United States and banks in Europe, predominantly Europe though. But the problem with it is that I think there's more to the deal than meets the eye, because the banks don't just say, okay, let's just cut 50% of Greece's debt and we'll be happy with that. Sure. You know, there's got to be another deal on the table. Something has to be coming to those banks that they're willing to do that. And this is the problem with the European deal. You know, you have 17 nations coming together saying, we're going to do something, and you see what happens in our country when one nation comes together. Right.
Now, you've been saying, actually, though, for a couple of years that Greece really isn't the biggest problem in Europe, that Italy, who's coming down the line. What are the chances right now that there's a smokescreen? Greece is a smokescreen for the bigger problem in Italy.
Well, there's no doubt that Italy is going to be a major problem. And actually, I think France could be even another one that follows Italy. Oof. Because, you know, it's the French banks have been making some of the biggest mistakes. And if you look at all the numbers, the French banks are really undercapitalized in regard to the risk they have to Italian banks, to Italy and Greece and Spain and Portugal, etc. It's not a pretty picture. So
meanwhile, though, back in the United States, we're seeing a lot of good news. I heard a statistic the other day that Apple has enough cash on the books alone to buy GM outright. And you hear this with a lot of U.S. corporations. But do we have a chance to move forward into positive territory without resolution in Europe?
Well, that's the paradox that we have, is that we have a lot of good news that, money supply has been growing very rapidly, interest rates are very low, and corporations have a lot of cash on their balance sheets. Their balance sheets are probably as good as we've seen them, and their earnings have been growing nicely in a lot of S&P 500 companies. The problem, though, is that we're very interrelated with Europe, and a banking crisis is the worst thing that an investor can be dealing with.
Sure.
It's because
the lifeblood of the system.
Banks are the lifeblood of the system, and you can't. Business isn't going to proceed forward without banks. And if Europe banks run into a serious quagmire, and they really just continue to shut down, and they're shutting down. They just haven't totally shut down, but they are shutting down. It's going to affect American banks, which are going to affect Japanese banks and Chinese banks, and it's not a pretty picture.
Yeah, one other little scary spot on the U.S. side of things, though, is that the flight to safety from all over the world of people buying a lot of U.S. government bonds and paper. What does that mean for the future? Does that scare you at all?
Absolutely. There are 2 things as an investor that you always are afraid of. Number 1 is fear and greed. If you see fear or greed moving something, you want to go in the opposite direction. Okay. And number 2, manipulation. Sure. So if you see manipulation taking place, you want to go in the opposite direction. Well, the U.S. government bond market has both. The U.S. government bond market is run by fear right now. Sure. People are giving their money to the government at 2% rate of return for 10 years with the rate of inflation at 3%.
Right.
So
guaranteeing yourself to lose.
That's right. This year, Social Security recipients are going to get a 3.6% inflation increase. That's because inflation was 3.6%.
Right.
But investors are turning around giving their money to the United States government and saying, just give me 2% and I'll be happy because I'm too afraid that I'm going to lose my money. I'd rather lose a little to inflation than actually lose the principal itself. That's fear. And then you got manipulation. You've got the Federal Reserve in the market saying specifically, we're going to sell short-term bonds, we're going to buy long-term bonds because we're going to try to manipulate the rates lower. So you got manipulation and you got fear. Now here's the problem, Tim, and that is that just because you got manipulation and fear doesn't mean that it'll automatically just collapse tomorrow.
Right, sure.
It could go on for a year or 2 years or 3 years. In 1998, 1999, I was sitting there saying, nobody should buy tech stocks. This is ridiculous.
Right.
For 2 years, I looked like a complete fool.
Yeah.
But finally, in 2000, it proved itself out. I'm saying the same thing for about a year or two now on the U.S. Treasury bond market, and I look like a complete fool. But I believe when it's over, you're going to be really glad you don't own U.S. government bonds.
So what should folks be doing today in their 401ks and then move into what are we doing? Where do we find opportunity, even as things seem to languish in Europe?
In their 401ks, I think that you just stay completely as safe as you can. Whatever the safest investments you can find in there, you ought to just stay there. Even if the market runs up, I wouldn't be too concerned about it. At least your money is safe in there for right now. Because
too many question marks.
And you don't have a lot of investment choices either.
Right.
What are we doing? Well, we're giving our money, lending it to countries that are paying us a fair rate of interest for their inflation rate. And we think their currencies are some of the strongest in the world. So we're buying international bond funds with managers that we believe understand this principle.
Yeah, sure.
And number two, commodities. I think commodities are a great opportunity. Gold, silver, agriculture, and so forth. We're adding to positions in that regard. And we're keeping a whole bunch of money in cash.
Sure. And we are reducing equity positions, aren't we?
We've reduced equity positions down dramatically. Even our growth clients aren't at anything more than 40% equity exposure at this point in time. Our conservative clients are probably down to 15% equity exposure. And a lot of cash, 40 to 50% in cash right now. Because when the buying opportunity comes, it's going to be very attractive.
That's good to have then.
Yeah. Anyway, so we got to just wrap it up right now. This is Drew Tignanelli saying God bless.